Welcome to our weekly Forex and financial market forecast. My name is Jay Norris. As always, we need to remind you that trading Forex or any market are risky endeavors and not suitable for all investors. I've written a couple of books on trading which were published by McGraw-Hill. I'm also the Director of Education at Trading University and a market strategist at EOS Trade. Let's get right to the markets. First market we're looking at is the Australian dollar. You know, we were spot on last weekend when we said, well, we're kind of nervous at the Aussie at these levels. There's no need to change horses. I think you're still looking at a healthy uptrend overall. It did back down, though. I guess the one thing that you could be disappointed in if you're long the Aussie or if you're looking to get long the Aussie would be weakness last week, particularly in the strength of the U.S. stock market performance, also dollar yen. Here, let me give you an example. Let me show you a neat chart. This chart tracks so many of the markets we follow simultaneously. The blue line, in fact, is the Australian dollar. The black line is dollar yen. The white line, that's the U.S. stock market, the S&P 500. The yellow line is the euro, and that red line is Aussie yen. What's interesting is clearly we're seeing Australian dollar weakness. Now, my initial concern would be that the Australian dollar is a leading indicator mark for the market because it has that yield. So you have to ask the question, why is the Australian dollar lagging? I think the important thing is not to read too much into that. There's no doubt about it that the Aussie is displaying weakness, and in the face of definitely stock market strength, dollar yen strength, euro strength. But again, you know, you can't read too much into that. We'll have to see. I mean, is it telling us that because the Aussie's lagging so badly that perhaps we're seeing a slowdown in China? Not sure. We'll have to see. But yeah, it's a bit of a cause for concern. But when we come back to the individual chart, the Aussie candlestick chart, I'm still looking at a healthy uptrend. I see a market that continues to put in higher lows. So that's a healthy thing. So what did we say last week? If we get a shot at, if we like the Australian dollar here, if you get a shot at 103, that's exciting. If you get a shot at 101, that's even better. So let's just sit tight and see how this correction plays out. Always interesting when what was a leader becomes a laggard. More times than not, I think the market's just taking a break. I think the strong dollar yen, strong stock market kind of sucking money out of the more conservative Aussie into those more speculative markets. Certainly momentum plays a huge part in all these markets. So I'm thinking, given that the Aussie, it's almost like a world bond market right now with that big yield. So maybe that's it. Just money coming out of the Aussie, chasing some of those riskier, faster momentum plays. But we'll keep an eye on things for you. Next market would be the euro. You know, euro all along we've been saying, hey, we think it's got a little bit more upside. I sound like a broken record. I do think there's a little more upside. I don't think we would view long euro as an investor. Not at all. Euro is definitely a good trading vehicle right now. And as we've said all along, the closer you get to this primary sell zone, the more attractive potential sell setups become. I've said, hey, I'll look for a double top against 35 even to consider a counter trend short. Ideally, though, you pop through 35 even, you run some stops, and you can get a double top somewhere in this area, perhaps closer to 138. We'll have to see. You know, we spoke of momentum before. This market has momentum on its side. You've got momentum to the upside, albeit you're just beneath resistance. So let's see how this will play out. I think from a longer-term perspective, you need to be focusing more on any kind of topping formation in this wide zone here. Keep in mind, markets being what they are, momentum behind it, you know, you could see a spike higher, no doubt about it. But from a longer term perspective, we still view this as a secondary move. We still see the big picture as one where the longer term pattern is bearish. There you can see it. So this is just a 50% retracement of this entire move going back a year and a half or so. So that's the big picture. We just have to stay patient and see if we do get some kind of a topping formation to potentially take advantage of in this area on the chart. Dollar yen. Well, let's cover the pound dollar next. Pound dollar is another one. You know, we pointed out the recent weakness in this market. Last week, we'd point out that the day-to-day shifted down. You continue to see weakness in this market, albeit a little bit longer term. Now you're getting into a buy zone here. We see pretty good support down here. Right around 157. With the momentum you have on it, you'll probably see that also. I think we can remove the top of that buy zone there. So we're looking for support down in here. This is a different picture. This is not the euro. This is the pound, obviously. Here where we think that if this secondary pattern holds up, then this is going to be worth taking a look at. Pound's been a pretty good trading vehicle for a long time in that you're mostly sideways. So we don't see anything changing there in the big picture. Certainly, this market can, if it chips down through 57, maybe you have another shot at 54. That may be a little bit of a stretch. We think 157 is going to be a good level to watch for potential longer-term setups. Again, you have to look at it a bit like the Aussie. It's definitely weak now. You don't want to read too much into that. It has been a long-term trading range, so you may just be backing down into the middle of that trading range, and we'll see then if you find support in the middle here at 157. So you can't rule that out as a pretty good trading vehicle, number one. And number two, let's see if support holds at 57. If you see a turnaround in here, we may be interested in going long. Now we'll cover dollar-yen. Well, can we say this is a runaway market? We were talking last week as far as the long-term target par 100. It just keeps on chugging, doesn't it? Well, we'd wish it would give us a little bit steeper dip here, steeper correction, because it's difficult to trade a market that's going up, 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 up. It's also difficult to let profits run too, to continue to hold it. I tell you what, one of the trickiest things in this business is trying to predict corrections. So many times you're better off just staying with the trend, and that's the case with dollar-yen. I think we spoke last week. We hope we get a correction, but you can't trade on hope, right? This is one big bull market. It seems to be getting a little stretched so far, but no sight and top, given that long-term target is still pretty far up there. So not quite sure what to make of that as a trading vehicle, but as a long-term investment, obviously the momentum is still higher. Let's take a look at the U.S. stock market. Big week in the stock market. We referenced this before. You got to think that the Aussie's performance is disappointing in the face of a much stronger stock market. But as I said before, we don't want to read too much into that, but we'll definitely continue to monitor it. But boy, this is a pretty bullish chart, and you can see that long term that resistance line up there. Let me pan out to a weekly chart. That's your all-time high in the stock market. Another way of looking at the stock market right now is that the stock market's trading all the way back where it was trading in 2007. So really, the stock market's gone nowhere for the past 6 years, right? So that's one way of looking at it. And I know there's a lot of people out there, they'd like to see a stock market correction. They're talking about a stock market correction just because it appears a little bit stretched, near term, but you look at the big picture, hey, it finally got back to the 2007 level. So this market's basically unchanged in 6 years. So if it did consolidate a little bit, it wouldn't surprise me that you go for that all-time high. I think with the momentum in it now, you're probably going to see that all-time high. But my point being with pointing out that, from the perspective of 2007, the market's unchanged. To me, that tells me there's longer term, there's quite a bit of room up here, right? There's plenty of room up above for this market. Let's take a look at the gold market. A lot of traders are disappointed with the performance of gold in the fourth quarter of last year. To us, that's normal behavior. You hit resistance right where we would expect it to be, right around 1800. We don't think you can write off gold at all. We wrote about gold this weekend on our Seeking Alpha blog, and I'll put the link to that on this YouTube video below there, so you can read that if you'd like. We like gold in this area here. We think gold's worth monitoring. We point out the 1650 level, potentially an area to watch. And if you see it on the daily chart, you can start to see it a potential head and shoulder bottom right here. We think this level's worth watching. The most interesting thing about gold, and why you can't write gold off, is because gold's become very popular for U.S. 401k holders. Gold's very popular as it is around the globe. But gold, the last couple of years, because it's performed so well, it's really made inroads with the younger crowd in the United States. These young kids that are working for these Fortune 500 companies, they can put gold in their 401k. They're going to. So it's not just that the institutions started to ramp up with the gold, about 5-6 years ago, a little bit longer than that even, where they decided, well, we better put 6, 7, maybe even 8% of our funds in gold. A lot of the big institutions viewed gold that way. But now you're seeing individuals too, and don't think that that's not powerful. If you think of all these people working for the Fortune 500 companies, how they contribute money on a monthly basis or every other week into their 401ks, you can imagine that's going to be a lot of money going into these markets twice a month. So now that it's easy enough for folks to put gold in their 401k, gold's had a heck of a performance going back the last 5-6 years. We don't see that new trend ending anytime soon. That trend, I'm not saying that you'll continue to see gold perform as it had the last 5 or 6 years, but you will continue to see more and more people you will see more and more people using that option to put gold in their 401ks. What that means long term is you're going to have a bid in this market. So gold's one to watch. Hey, thank you so much, and we'll catch up with you again later in the week.